When billionaire investors load up on specific stocks, it's a blaring alarm for other investors to wake up and pay attention. That's exactly what we're going to do in today's video. For example, one of Wall Street's most respected quant funds more than quintupled its position in just one stock. That stock is on the video today. Larry Robbins, the billionaire who runs Glenview Capital, has a 7.5% of his portfolio in a single name. That one's on the video today as well. Brandis Investment Partners holds over 13% of the float on our final pick. And that one's one of my favorites too, so keep watching all the way to the end. These moves show up in regulatory filings called 13Fs. Every hedge fund managing over 100 million has to file them. So if you want to know what the smart money is actually doing, that you don't look at what they say on CNBC, you look at what they're actually buying right now. So today, I'm showing you 5 stocks where the 13F filings reveal real billionaire conviction. I then ran them through our Zen ratings quant model, which analyzes 115 different fundamental factors which point to the healthiest stocks. All 5 stocks today grade in the top 2% of this quantitative model. Now, if you find this useful, then please hit that like button before we get into it. It tells the algorithm to show you more videos like this in the future, and gladly it costs you nothing. And by the way, I'm Steve Reitmeister, but all my friends call me Righty. I spent over a decade as editor-in-chief of Zacks.com, covering topics like quantitative analysis and institutional money flows, and now I'm a partner at WallStreetZen. And as I dig into stocks, I want to make it clear, I'm not your investment advisor. I'm just showing you the data. Always be sure to do your own due diligence before you buy or sell any stock. Now, that being said, let's get the ball rolling with stock number 1. That's Jones Lang LaSalle with a symbol of JLL. This is a commercial real estate giant. They broker deals, they manage properties, they advise on capital markets. That includes advisory work on data center sites. One of the fastest growing corners of the commercial real estate market is AI infrastructure spending ramps up greatly. All right, that profile appealed greatly to AQR Capital, the quant shop founded by billionaire Cliff Asness, right? They pumped in another $250 million into JLL shares, representing a 420% jump in their position. It's good to note that AQR manages over $100 billion, and their quant models have a 30-year proven track record. So when AQR flags a stock for that kind of position size, it isn't just throwing spaghetti against the wall to see what sticks. And they're not alone. John Rogers at Ariel Investments, one of the most long-tenured value investors on Wall Street, has held JLL as one of his firm's largest positions for many years. And here's why the billionaires may be buying right now. In their fourth quarter earnings of 2025, it came in 18% better than expected. In fact, they have beaten earnings estimates for 9 straight quarters. For the full year, revenue growth of 11% translated into earnings growth of 45%. It's not hard to see how that kind of operating leverage might attract the institutional money. Wall Street analysts have noticed all this as well. In late April, Alex Cram from UBS, who ranks in the top 11% of all analysts in terms of his actual stock picking performance, he reiterated his strong buy in the stock. He has the street high price target of $445. That's roughly 32% potential upside, which is much more than your average large cap stock. Now, it's important to remember that analysts aren't fortune tellers. They're just people, but they do have more expertise than most retail investors, so it's worth listening to what they have to say. Now, let's review JLL through the lens of the Zen Ratings quant model. Here we have a coveted A rating, which implies a strong buy recommendation. Even better, the company scores in the top 1% of the 4,600 stocks we track. Each component grade on the screen shows how the stock ranks on a specific dimension. Financials grade in the top 3%. Our in-house AI factor grades in the top 4%. And sentiment, which aggregates institutional money flows, analyst upgrades, and insider activity, that puts the stock in the top 17% for sentiment. Okay. Right now is trading at around 16 times forward earnings. That is part of why it ranks in the top 18% for value. And on top of all that, it's in the top 15% for growth. A really strong all-rounder when it comes to its fundamental profile. Yes, you might have peeped the C ratings on safety and momentum, but that's average scores, not really bad ones. A potential issue with Jones Lang LaSalle is that the broader commercial real estate services sector isn't rated highly by our model, but JLL appears to be an exception to this challenge industry. Here, you're looking more at the stock than the attractiveness of the industry itself. But that having been said, it's hard to deny the facts. One large hedge fund quintupled its position, and one of the most respected value investors out there there has been one of his top holdings. Couple that with the strong analyst ratings and high scores in our quant model, and you have multiple signals pointing the same direction that these shares may deserve a spot in your portfolio. One quick thing before the next pick. We publish videos like this every week, breaking down stock picks, our model flags before Wall Street catches on. If you don't want to miss the next one, then hit subscribe and click on the notification bell. Now, the next pick has an earnings beat streak that makes JLL's 9 quarters look paltry by comparison. That brings us to stock number 2 in Valero Energy with a symbol VLO. This is the second largest oil refiner in North America. They take crude oil, run it through the refineries, and produce gasoline, diesel, jet fuel, and petrochemicals. Now, let's talk about a prominent investor in the stock. We're talking about Arrow Street Capital. The firm was founded by one of the most cited financial economists alive. We're talking about Harvard's John Campbell. They manage about $290 billion, but keep a low profile. They're certainly not the type to take a new position lightly. In Q3 of last year, they opened a brand new position in Valero worth about $275 million. And then in the latest Q4 filings, they increased that position by another 50%. That is pretty aggressive accumulation of shares. Now, what's their attraction to Valero? Perhaps it's the winning streak I teased earlier. Amazingly, Valero has beaten Wall Street earnings estimates for 19 consecutive quarters. The most recent was another clear signal of success with a hearty 17% beat. That may be common for a small cap, but not for a company of this size. This fundamental strength shows up in their Zen ratings analysis, putting Valero in the top 2% of all stocks in our database. On top of that, we have top 19% for sentiment, meaning the smart money is lining up behind the stock, top 12% for financial strength, top 7% for momentum, and top 12% for growth. This is because of the consistency of their exceptional growth across earnings, margins, EBITDA, and cash flow. The honest concern is revenue. Refining is a cyclical business, and top-line revenue has declined over the past 3 years as crack spreads normalize. Valero has been executing on that spread better than almost any of its peers, which is what's showing up in the rest of the growth categories. But remember, this is a company that has beaten earnings estimates for 19 straight quarters. We all know the past performance does not guarantee future results, but the continued support from the likes of Arrow Street and our quant model shouldn't be discounted. So do consider if you should refine some Valero shares into your portfolio. Before we move on to the next stock, a quick aside. Every Monday, I share my stock of the week with investors. This blends the outperformance found in the Zen Ratings quant model, along with my greater than 40 years of investing experience. Get all of my future stocks of the week for free by clicking the link in the description or scanning the QR code. No doubt 19 consecutive beats for Valero is impressive. However, the next pick goes for some one-upsmanship with 20 consecutive beats. This is a company that you'll surely recognize but may not have considered as an investment. I'm talking about Levi Strauss with the symbol of LEVI. With Levi Strauss, the billionaire angle is a bit different from the first two picks we talked about. There isn't one marquee name. Instead, I'm picking up on some impressive smart money signals spread across our quantitative data. This shows up in our sentiment component score on Levi Strauss, which is an A rating, placing the top 3% of all stocks in our database. That grade aggregates institutional money flows, analyst upgrades, earnings estimate revisions, and insider buying activity. When you see a sentiment grade of A, it means dozens of institutional forces are moving the same direction at the same time, often a signal worth heeding, right? As for their most recent earnings report, they beat estimates by 13%. This is thanks to revenue growth of 14% year over year, translating into even better earnings growth of 26%. Direct-to-consumer sales hit 52% of total revenue for the first time in company history, a milestone for this transformation strategy they've been building on for years. This helped propel them to their 20th consecutive quarter of beating earnings estimates. Think about what that means for a second. That's 5 straight years, including a retail inventory crisis, a full CEO transition, and yet the string of beats just kept rolling on. The overall Wall Street analyst picture is stacked in their favor, given that all those coverings see it as a buy or a strong buy rated stock. The average fair value target implies potential upside of about 26%, but note those forecasts go as high as 51% above current levels. The Zen Ratings puts Levi Strauss in the top 1% of our database, reflecting the impressive fundamental profile of the firm. Now, as we drill down to the component grades, they score in the top 13% in 3 different vital categories. We're talking about value, growth, and safety. Even better is the financial grade in the top 7% of stocks we track. There are 2 honest caveats on these shares. First, the dividend has been inconsistent over the past 7 years. Plus, the debt to equity ratio sits a bit too high, around 2, which hopefully they can whittle down over time. These are issues worth noting, but with 20 straight quarters of earnings beats, a top-tier sentiment grade, raised guidance, and accelerated share repurchases, it means that this is a solid stock you might want to button up for your portfolio. The next pick has a lot of support. Glenview Capital's $337 million anchor position. Elliott Management is also on board, and a billionaire publicly pitched it as his top idea at the 2025 Sohn Conference. That brings us to stock number 4 in Teva Pharmaceuticals with the symbol of TEVA. 5 years ago, Teva was a pathetic punchline, buried under $35 billion in debt, drowning in opioid litigation, and generics business was getting commoditized. The stock was a zombie, and for good reason. Here's what the smart money figured out first. The turnaround wasn't coming. It had already arrived. Their pivot to growth strategy wasn't just some PowerPoint theater. It's showing up in their actual quarterly reports, including 11 consecutive quarters of revenue growth. Even more impressive was the 48% earnings beat in the Q4 of 2025. S&P and Moody's upgraded their credit rating, which is vital given their hefty debt load. And the market is only now starting to price that into shares. Last year, Larry Robbins took the stage of the 2025 Sohn Investment Conference and pitched Teva as his top investment idea in front of just about every major hedge fund manager in the country. Then in Q3, he added another $72 million to his position, and the stock rallied 50% through Q4. Robbins held on to every share, expecting more good times to come. The position is now worth over $520 million, representing about 11% of his fund. Teva's drug pipeline is what makes this exciting. Their flagship drug for movement disorders is closing in on $2 billion in annual sales, and Teva's own guidance has it hitting $3 billion at its peak. They're rolling out cheaper versions of expensive biologic drugs, which are high-margin businesses that print cash. And their newest drug cleared a major clinical trial. Blackstone even wrote a $400 million check to help them fund the next stage of testing. 7 analysts in our system track Teva, 6 of which are pounding the table with strong buy recommendations. The other is still a solid buy. The average price target implies upside potential almost 30% in the year ahead, while the street high forecast is calling for a 44% increase. Almost everyone wrote off this company for dead, but the bull case for it was always in the data, so the smart money held and accumulated. Speaking of the data, our quant model gives Teva an A overall, and it currently ranks in the top 2% of all stocks in our database. Looking at the component grades that make up the overall rating, growth and safety both score in the top 8% of all stocks. Value sits in the top 12%, with Teva trading at just 11.4 times forward earnings. That makes a lot of sense. That definitely is at the low end of what you would expect for a large cap biopharma company and points to ample upside potential for those who want a healthy dose of Teva shares. All right, now it's time for my final pick. This is a case where a legendary value investor holds over 10% of the entire company, and the earnings just came in 88% higher than a year ago. Yet Wall Street is stuck at a hold, right? I'm talking about Kennametal. This is our 5th and final stock today. Not exactly a household name. Kennametal with the symbol of KMT. The company makes industrial cutting tools and wear-resistant components. These are the parts that go into aerospace manufacturing, energy infrastructure, and heavy industrial product lines, right? So kind of a boring business, but in growth areas of the economy, right? This is essential stuff and almost impossible to replace once they're integrated into a production process. Now, the prominent investors, we're talking about Brandis Investment Partners. It's a value investing firm founded by Charles Brandis, one of the disciples of legendary Benjamin Graham. Brandis owns over 13% of the entire company. That's a major commitment. Most value funds would cap out their holdings at about 5% to preserve diversity and increase their liquidity. Brandis more than doubled that threshold to load up on Kennametal. John Rogers at Ariel Investments is a holder too. That's the same John Rogers I mentioned earlier, who was a buyer of Jones Lang LaSalle. When the same 2 long-tenured value shops anchor a small industrial play, it tends to reflect something deeper in the works. And that is explosive earnings momentum. Their most recent report was just another in a long line of beats, but they raised guidance a whopping 50% above street expectations. Not surprisingly, our Zen rating system is picking up on Kennametal's fundamental prowess. In fact, it was recently the #1 rated stock of all 4,600 stocks in our database. Let's look into those component grades to see where that particular strength shows up. We're talking about top 11% for momentum, top 6% for safety, top 4% for growth. All in all, it paints a picture of a company firing on nearly every fundamental cylinder. But here's where it gets contrarian. Despite all this recent growth, the Wall Street analyst consensus on Kennametal is still a hold. But here's the good news on that. I spent nearly 2 decades in Zacks investment research. Our studies showed that analysts are often late to the party with upgrades. So not shocking that analysts are out of date with these hold ratings. My bet is with the Kennametal bulls. That includes 2 of the best value funds RA hoarding shares, and our Zen ratings model recently rating it as the highest ranked stock in our universe. This all led me to add it to my Zen Investor newsletter portfolio just in time for the latest earnings beat. Okay, now I want to hear from you guys in the comments sections. Which of these 5 picks looks the most interesting and the promising one to hold, and why? Please share your thoughts with our community in the comments section below. Plus, I always check in and often respond to people's messages, right? If you're interested in something a bit different, like how these same hedge funds manipulate your portfolio, then here's what you should watch next. I recently did a video covering what legendary Jim Cramer had to say about this topic. That video is popping up on your screen right now. It's worth a watch. There are some hard lessons to take in there, so go in and check it out now.